Hello,
Hi,
how's it going?
it's going well. Have you been?
All right. So we got two more sessions online, and then I'll have to remind everyone we've got one more scheduled in person at the end of this month, the 29th. But of course, I'll remind everyone as we go
Yeah.
along. But for now, it's still online. That's good. So, looking forward to Easter.
Yes. I it's weird. I mean, I guess we usually don't have a day off after.
Oh, do you really?
No, we don't. Like we don't have a day off after, but like
Oh,
in my head, I feel like we do
oh,
for some reason.
yeah, as far as I know, they don't have any time off related to Easter, but they did have that day off that nobody knew about earlier in the semester, if I remember correctly. There
Yeah.
was that one day that fell out of nowhere. So I guess they figured like they don't owe us any more holidays, but um, so that's how that is. So, all right. Anyway, I'm going to get everything open and we'll give a few people a few minutes to get shown up here. And let's see, where is I can always tell when my computer was rebooted while I was away. I'm sure that Windows was having its way with my computer this afternoon while I was at school. I can always tell. I walk around, I'm looking at all these files and websites and like, wait a minute, this doesn't look right. So I'm trying to see where, you know, uh, oh yes, where my Manhattanville website is. It probably got turned off. So I'll just go turn it back on. All right, so let's get this. This will be chapter 11. Let's get that open. So I'm running financial markets during the summer. They, that they're going to try, they're starting, I guess everything's done or is almost done, that they decided that they could really use an MBA to go along, I guess, with the existing programs. And I don't know if that's supposed to be a secret or not, but I guess they've been working on this for a while. And I'm starting to think that possibly, when they changed their name, was it last year? Do you remember? Was it last year they
Yeah,
decided?
I think it was last year.
Last year. Yeah, it might have all been part of a grand strategy that it may be that not being a university would have made it harder to offer an MBA program, but I don't really know all the details, but I do know that I've been, discussing it with them about what we're going to offer. And well, let's just say that in order to have a full-blown MBA program, they're going to have to offer more courses. So one of them is called Financial Markets, and it's an MS or MBA level class, and so it's available this summer online. But of course, you never know when things can get canceled during the summer. But anyway, so I don't remember what you're focusing on, but if that sounds interesting.
Yeah, because right now I'm doing the master's in finance. Do you think it's better to do an MBA?
I don't know. See, now that's a very good question. Because the difference between the two is that MS is more focused. You're just taking the classes that really are important for what you're trying to do. The MBA, they're trying to give you a little bit of everything, like not just finance, but also accounting and marketing and management and all the rest. It's more general, let's just say. But then it usually entails a lot more credits. So, if you're only interested in finance, maybe not. But on the other hand, in the job market, these places don't seem to understand what an MS is. It's not nearly as well known. So, there's a certain amount of name recognition going on with an MBA that you might not get with an MS. But if you already have an MS, I mean, I'm sure they would let you carry on and take another however many credits to get the full-blown MBA. That way you could have both degrees on your resume, which would look pretty cool.
Wow, I have to talk to them. That's good to know. Thank
Yeah,
you.
I would definitely. I'm not sure if they've gotten it to that point yet where we're still in the fair. I mean, it's late. I wouldn't say it's early in the planning stage. The planning has already been done. They're just now wrapping up, I think, the last minute details. So they may not have stopped and said, listen, let's have a separate strategy for people who would like to take an MS and turn it into MBA. But you can still ask them and see what they say. What they'll probably tell you is that, well, we're getting there. We're getting there. We will
Yeah.
let you know how that would work. But I wouldn't be surprised if people do that, because I do believe that you might find that an MBA is a little bit more, has a little more name recognition. And some organizations would prefer to have an MBA. So unless it's going to cost you a fortune that you can't afford, if you have an employer who can help out, I would definitely at least look into it.
Well, thank you. Yeah, I definitely want to now.
Yeah, I think it's a good idea because more credentials, there's no way more credentials can be harmful to you.
Yeah, exactly.
If you're willing to put in the time and effort, and if you have access to the money, why not? I mean, really, it's not going to stretch it out that much longer. It's not like you're going to be doing this until you're 40 or anything.
Yeah.
It's something totally worthwhile investigating. Since you're already here, you're at school, you're doing all these courses. If you wait 10 years and come back, well, maybe you've forgotten everything you ever learned. And that would be the end of it.
And I feel like also, are they making all the classes like asynchronous?
Yes, now that's the other thing too. They have apparently decided that in the past they weren't able to get enough students because of the scheduling. And by having it asynchronous, and I've done asynchronous classes at other schools, especially during the summer when nobody has the same schedule. And
Yeah.
the beauty of that kind of thing is that, you when you get a chance, you sit down and you watch the lecture and you work on the assignments, and everybody's completely on their own basically as far as the scheduling goes. And I think that that's a great idea because people, especially let's say you work in the city and you don't know when you're going to get home and all this and that. If you're stuck at work, what's the big deal? You just wait till the next day to watch your lecture. So,
Yeah.
so I think it would open doors for a lot of people who otherwise couldn't even think about getting a degree. And it's not just, I mean, all the big schools are doing it too. Like I sometimes get ads from University of, no, it's Penn State actually. They they occasionally send me ads. They have a master's degree program, I think in statistics. And somehow they found out that I, teach statistics. So every so often I get literature from them saying, our MS program in statistics is entirely online. You might be interested. And the thing is, but at the same time, though, asynchronous does take a lot of self-discipline. You have to do everything at home on your own. Not that you don't have access to professors, but some people just would not be able to do that. End of story. They would just put it off. They would never get around to it. So it does take a certain amount of self-discipline, but man, the flexibility is unbelievable.
Yeah.
In fact, I actually had a class one summer, not at Manhattanville. It was another school, but I was teaching a college level class, and it was the way it was set up was that we officially met at a certain time every week, but it was made clear to everyone that attendance wasn't actually necessary because it was sort of like a hybrid, synchronous and asynchronous. So I found that in a class of like 20 people, one person would show up at a scheduled time, and that was it. The rest of them would just do their own thing. And so it really has gotten to that point where people are expecting to be able to do things online. They expect to be able to do things no matter where they're located. So by having it asynchronous, like people like who live in other states could actually do this program. And so it almost doesn't matter anymore where anyone lives or where they work. You can still get one of these degrees. Okay. So
Yeah.
that's why I like it so much. Um, but you've got to look at the program, look at the courses you'd have to take. And see, now I never went down that path because the only thing I would have found interesting in, of course, the quantitative courses and the finance courses. I did not want to deal with accounting or management or marketing or the others. And so I did not, but it didn't matter because I wasn't going into management anyway. I
Yeah.
always, even when I was stuck in the corporate world, I always was aiming towards academia. So in academia, an MBA is not such a big deal. It's really the PhD that people want, which is more research oriented. So anyway, but I think a credential like that can only come in handy. And you never know how many more credits. I mean, since it's the same school, they'll probably accept all of your credits and transfer, which might not happen at another MBA program.
Yeah, like it wouldn't hurt to look into at this point.
Yeah,
Yeah.
at least find out. But
Yeah.
maybe wait till at least the fall when they're really getting it going, because right now they're probably in a state of chaos trying to get everything ready for the fall.
Yeah, and I definitely have to like wait to graduate first so then I could like take more classes
That
because I'm
might
still
help
an
too.
undergrad. So they wouldn't even
Yeah,
let me take classes yet.
right. Yeah, that could get a little tricky, but some schools will allow seniors to take graduate level classes. And they have these 5-year programs. They have them at Fordham where accounting majors can get a BA, MA in 5 years, or MBA, whatever it is. And I know somebody who actually did that. So it's doable. It
Yeah,
can be
I'm in
done.
the 4+1 program here.
Oh, right, right, right. That's right. They do have that. So what do you
Yeah.
get both degrees in 5 years?
So it's like yeah, you get both degrees in 5 years. So you can only take four like graduate classes while you're still an
Oh,
undergrad, and then once you graduate,
oh,
you could take the rest of them.
oh, I see. Okay, that way, because I guess they figure it would get a little overwhelming if you try to push your luck and,
Yeah.
take too many. But still, it's a great idea because, the reality is, even when you're a senior, you're probably going to end up taking classes that you're just take because you have to. And, if you could replace those with MBA level classes, well, what's the harm? I mean, really.
Yeah.
So I like that too. So yeah, it's getting to the point where education is more flexible all the time, which is good because the traditional model, especially after COVID, that really broke down a lot of traditional relationships. That's why, like, I know somebody who he works in some hotshot Wall Street firm, but it's very, very small. And even all these years after the COVID has ended, they never went back to the office
Well,
because it's such a small company that they just decided it's not worth the cost to have an office. We'll just do everything online. As long as we don't have any issues with the clients, what the heck? So they're all happy about that, let me tell you. I know if I, like when I was in the corporate world, none of that was even on the table for anyone. It was unthinkable that, except for some very specialized positions, that anyone could just stay at home and work all day. Now, I mean, it's like, wow, it's a pretty normal thing. And I definitely would have gone for that because I hate commuting. It's like, huh. All right. Anyway, so with 11, we're actually this last section of chapters is all about managing risk, but in each case, it's a different kind of risk. So this one, we're going to spend a little more time looking at how one would manage transaction exposure with more traditional approaches like derivatives, but also we're going to see how this is done with money, what are called money market hedges, which involve borrowing in one currency and lending in another one. Okay, so it's a strategy that had been around forever, even before derivatives became widely available. Because I don't know if I mentioned this, but in the United States, at least, while futures contracts have been available since at least the 19th century, traditionally they were all agricultural contracts. And so, in other words, if it was like, imagine yourself in 1876 Chicago, you could easily go to the Chicago Mercantile Exchange and get a contract on corn or wheat or rice or whatever. And but the idea of financial derivatives, derivatives like options and futures on currencies and stocks and other types of financial assets, gold and silver and you name it, that really got started in the 70s. And even then, it took a while for a lot of these products to become available. For example, after the Black-Scholes model was published in 1973, for a while, we only had equity options available. And not that many of them, as a matter of fact. But that soon changed once it became clear that the Black-Scholes model was a viable way of pricing European options. Then all of a sudden, clever Wall Street firms said, what about currency risk? Aren't there going to be companies out there and individuals who need to hedge their foreign exchange risk? And so all of a sudden we find currency options and futures are being traded. And then in the late 70s, when there's a lot of volatility in the interest rate markets and a lot of inflation, as a matter of fact, Wall Street realized that there's a demand for interest rate derivatives. And so all of a sudden they became available. And so a lot of these derivatives became available in response to a very specific need. And along the way, many derivatives have been offered, but were not successful and disappeared as a result. It's kind of like evolution in a way. A lot of derivatives have been tried, but the ones that were extremely useful have survived. Only those have survived. Okay, so a lot of the others have long since disappeared. But the concept of financial derivatives, again, is a relatively recent development compared to, let's say, money markets or bond markets, let's say. So some of these hedging strategies have been used for decades, decades even before derivatives became readily available. But it's always good to have access to different types of strategies because you never know what kind of situation you might find yourself in. And some types of hedging strategies are more flexible than others. Some are more expensive than others. Some are more time consuming. Some of them require more expertise than others. But any way you look at it, you can't realistically do business overseas without having some comfort level with hedging foreign exchange risk. The question is, how do we go about it? So we're going to take a look at some examples here. And by the way, here they're going to just make a distinction between payables and receivables. You're probably aware that if you've had any accounting at all, payables are funds that we owe but haven't paid yet. For example, let's say I'm a manufacturer and I produce, I don't know, furniture. Well, I'm going to be buying a lot of lumber from somebody. And so what happens is if I'm buying a lot of lumber from a supplier, probably I don't have to pay for each order individually. They may allow me to pay my invoices at the end of the month. So that means that when I've ordered wood and I've received it, but I haven't paid for it yet, it's known as a payable or an accounts payable. Or like any company out there is going to need Xerox paper. Okay, you can't survive without Xeroxing. So every corporation in America probably has a payable due to some paper supplier or other. Okay, so in other words, at any given time, every time we order paper for a Xerox machine, we probably are being allowed to pay for it at some point in the future. And in the meantime, they're known as payables. Now, the problem with that is if our supplier is a foreign company and they're charging us a foreign currency, that means that fluctuations in the exchange rate could ultimately cause our payables to become more expensive. Then, of course, we also have receivables. We may have foreign countries, customers rather, in foreign countries that are buying our products, but we may be allowing them to pay in their own domestic currency. For example, like if you go to an Apple store in Spain, you're going to see the prices are all in euros. They don't expect Spanish citizens to pay dollars for Apple products. That would be ridiculous. So they charge a price in euros, and then all those euros are received by Apple, but their price can fluctuate. And so if things go wrong, those euros could end up being worth fewer dollars than Apple expected, and that could cause losses. So we need to understand how to hedge both payables and receivables, understand the limits of hedging. The problem with hedging too is that if you're not careful, you could hedge away all of your profits if you're too aggressive about it. And then we also want to be alert to other ways of reducing our risk. Sometimes, for example, we can make arrangements with our suppliers to trade, goods directly with them or something like that. So we'll see some ideas for doing that right here. All right. Now, first of all, another question that comes up when we hedge is whether or not we should hedge all of our exposure or just some of it. Okay. And again, because the more we hedge, the more we're locking in uh, the value of our receivables or payables, and we may end up eliminating opportunities to earn larger profits. So we actually had this conversation a while back about forecasting. We of course try to forecast exchange rates as accurately as possible, but there's a limit to how accurate your forecasts can ever be. I mean, you can have the most sophisticated models in the world, but things can go wrong in a hurry in the financial markets. So forecasting will help us understand how much hedging we should do in the future, but it's never going to be perfect. So we need to know roughly how much we need to hedge. And then we have to take into account the fact that all this forecasting leaves us open to a lot of uncertainty and risk. We also want to know how much these transactions impact on our bottom line. So if we're doing business and buying supplies overseas, but it only represents a small percentage of our inputs, then maybe the amount of foreign exchange risk that we're exposed to is not worth worrying about. So a lot of this depends on what percentage of our revenues or expenses are actually denominated in foreign currencies. And then we also have to consider that hedging does carry a cost with it, even if it's just an opportunity cost. Okay, now there may be transactions. By the way, you probably were exposed to that in some economics class or other. Just in case we've forgotten what this means, in economics, we make a distinction between two types of costs. So this is a bit of a detour into economics. There are two types of explicit costs. Costs that are paid directly, let's say. Now, what would be some examples of this? For example, a Starbucks must pay for a lot of things. Electricity, rent, salaries, etc. These are all explicit costs because they have to write a check for these expenses. What is an opportunity cost? Well, and by the way, this type of cost is often known as an implicit cost. Implicit or opportunity costs these are the value of a sacrificed alternative when a decision is. So what does that mean? So for example, if Starbucks spends $1 million opening up a new store in Barcelona, obviously the construction costs and all the rest would be explicit costs. The opportunity cost would be the rate of return that could have been earned by investing the $1 million into something else. Right. So in other words, what if we just put the money in the bank, for example, and we could have guaranteed ourselves $50,000 in interest every year? That's an opportunity cost. We have to take that into account when we make a decision whether or not to open up the store. So imagine that that's the case. That $1 million could have earned us a $50,000 interest payment every year. So if the profits of the new store are less than $50,000, that means it would make no sense to invest in this new store, even if we're making money. So let's throw that into our example. For example, suppose that this money could have invested in a bank and generated $50,000 interest every year. Now, suppose that Starbucks in Barcelona earns a profit of $40,000 a year. So you might say, well, fantastic, we're earning a $40,000 profit. The reality is the economic profit is actually a loss of $10,000 because, well, yes, we made $50,000, $40,000. We could have made 50 in the bank. So therefore, we would consider this to be a loss of $10,000. In other words, we're making ourselves worse off. So hedging, the point of all of this is that hedging can introduce opportunity costs. Resources used to hedge might have been used for some other purposes. So that again has to be considered when we decide how much it's really costing us to hedge our risk. Okay. So just be aware that, as you know, in economics, then explicit costs and opportunity costs. We have to take everything into account when we devise a hedging strategy. Okay, now here's the ones we're going to focus on: forwards and futures. We're not going to use swaps here. Swaps are very specific to each unique situation. Swaps only work well when we have a very specific repeated series of exposures. Like, for example, if we know that we have to borrow $1 million into foreign currency every 6 months for the next 10 years, that would be hedged. You can hedge that with a swap. These others are more flexible. A forward or futures hedge, you can attach it to the time frame that you need. A currency option, as we know, enables us to buy or sell something in the future, but we have the right to walk away from the whole thing. The money market is a different case altogether. The money market is where we borrow and lend short-term funds. You may have heard of this before. The money market is where short-term, highly liquid, safe, in, let's say, interest-bearing instruments are traded. So, you know, there's a lot of things that go in there. Like, for example, treasury bills are a perfect example. The treasury bills have a maturity of no more than a year. They're highly liquid. It's easy to sell a treasury bill. You won't have trouble selling them to somebody else. Of course, they're very safe, and they do provide us some kind of not an explicit interest payment, but they do provide us with a capital gain, which amounts to the same thing. So in the money market, what you can do is you can raise funds for short periods of time. You can also lend money, like a corporation, for example, that has, let's say for some reason they've just sold a division and they have $100 million laying around and they don't know what to do with it. They can buy money market securities and earn a risk-free rate of interest for short periods of time while they decide what to do with the money they got from their division. So it's not uncommon for corporations to park their surplus cash into these money market accounts that are available, where they just are investing in a portfolio of money market securities. You and I can do the same thing. I mean, it typically provides a higher rate of return than a savings account, but it's not quite as convenient because there might be transactions costs or there might be restrictions on how often you can trade. But they do exist. Individuals can invest. And it's a nice alternative to simply throwing all your money into a bank account. So that being the case, the money market hedges imply, so I'll just mention this here with a money market hedge. Corporations can hedge their foreign exchange exposures. By the way, it's common in literature to abbreviate foreign exchange FX. Okay, when you see FX, it means foreign exchange. There are FX exposures by lending in one currency and borrowing in another. For example, a US corporation could borrow dollars and convert them into pounds and then invest in British, let's say, money market securities. So, and then when they mature, then those pounds could be used to pay, let's say, expenses that we may have. So this way, what would be the point of doing this is that the dollar cost of doing this will be locked in advance. Okay. In other words, I know how many dollars I need or how many pounds I'll need in the future. So I can figure out in advance how many pounds I need today to grow into that amount. And so you're basically locking in the cost of the British pounds by simply borrowing the money you need and buying them now. So we'll see some examples of that later on. But you can see how this could be a quick, flexible, easy way of hedging exposures in foreign currencies. Okay. And we call that money market because these are very short-term transactions. All right. What happened? All right. Now, of course, the strategy that we will take will depend on whether we owe or our own, let's say we are borrowing and lending the foreign currency. For example, forwards and futures. Now, by the way, they're not gonna make a distinction here between forwards and futures. Um, of course, they're not exactly the same thing. We know there are some very important institutional differences, but the basic hedging strategy is the same in both cases. Okay. So whatever applies to a forward contract would equally apply to a futures contract, except possibly the amount that you hedge or whatever, but the strategy is the same. So MNC, by the way, stands for multinational corporation. So this strategy enables an MNC to lock in a specific exchange rate at which you can buy a currency. Now, this is used to hedge payables. In other words, if we know that we're going to owe money in the future, we're afraid that when it comes time to paying these bills, the cost of acquiring those currencies will be higher than it is today. So we'd like to lock in the price at which we can buy these currencies now so that we can lock in the price or the cost of paying off these payables in the future. So in other words, what they're saying is that if you are hedging payables, one possible strategy is to use a long forward or futures position. Now, remember here in this context, the word long means locking in the price of a future purchase. Right. So in other words, I would enter into this contract to buy, let's say, British pounds, because I know that down the road I'll need those pounds to pay my bills. Okay. So long is the means you're the buyer. Right. So just remember that with forwards and futures, the word long indicates that you're the buyer. If you're hedging payables, you're going to need to buy a foreign currency in the future to pay off these payables. So what you're doing here is you're locking in the price now. Now, when you enter into the forward contract, it'll specify all the details. Actually, why don't we make up a quick, simple example here of a US firm will need to pay 100,000 British pounds to a British supplier in 6 months. At the moment, spot exchange rate is $1.30 per pound. All right, that sounds about right anyway. So in fact, you know what? I haven't looked at Bloomberg in a while. I'm wondering what's going on. The markets have been in such turmoil lately. I wonder if the dollar has been getting affected by all this. About $1.32. That's about what it was. The euro, No, it doesn't look like the currency markets are being affected by world events right now. Not very much. Yeah, that's about what they were 6 months ago, I guess. So right here is dollar to pound, about $1.32 per pound. Each yen, for yen, if you're Japanese, you'd need to pay 143.14 yen to buy a dollar. Anybody in Europe, if you want, let's say you're traveling in Europe and you need a euro, you'd have to pay $1.1298. Ooh, yeah, look at that. You know what also is interesting? Just for the heck of it, let's come over here and look at CNBC. If anything exciting happened today, it'll be here. We had another rough day. But this time, you see now, it was the NASDAQ that really got hammered, and they're attributing that to NVIDIA, um, a $5 million charge. That means that they lost money. So, ooh, interesting. It's also interesting if you look at what percentage of these articles have something to do with AI. It seems to be growing all the time. Okay, you can't go anywhere anymore without hearing about AI. Man. It's gonna get to the point of telling you where AI is gonna do everything for us. All right, anyway, let's get back to this. So yes, now let's assume that at the moment, the 6 month forward exchange rate between the dollar and the pound is, let's say, $1.32 per pound. Okay, so the firm is hedging, can hedge its payables by entering into a forward contract, long forward contract, to buy the pounds in 6 months at the forward price of $1.32 per pound. So the cost of the pounds is guaranteed to be $132,000. End of story. Now, the opportunity cost comes in if the price drops. That means we lose the opportunity to save some money by buying the pounds at a cheaper price. But of course, we have no way of knowing that. So a lot of companies who are, terribly worried about risk will say, listen, we can't be fooling around with foreign exchange risk. I mean, this is not the business that we're in. We don't know what to expect in the future. So we're going to lock in this price. We don't care if there's a chance of saving money, blah, blah, blah. We're just going to go ahead and do this. So this is a very low risk way of hedging your risk by locking in the price that you'll pay for the pounds in the future. All right. So yes, so that means that in our contract, we've specified we're going to pay in this contract. Um, um, yeah, we're going to pay dollars. We're going to receive pounds, 100,000 pounds to be precise, at a rate of $1.32 per pound. That's our forward exchange rate. And the date in this case is exactly 6 months in the future, whatever that happens to be. Okay. So this is what the contract specifies. And the same thing would be true if we use a futures contract, only it will be a little trickier because the futures contract is not likely to expire on the exact date that we need it to. But now I mentioned this once before, I think that with futures contracts, most investors who are using them are not actually interested in buying the underlying asset. It's just a pure hedge. They're just going to collect their profits, and that's the end of it. Here, the forward contract is set up so we really will and truly take delivery of these pounds because that's what we want. But if you were to use futures contract here, to hedge the risk that the payables will become more expensive in the future, the position would be hedged with a long futures contract. Okay. And so if we don't really need to take delivery of the pounds, this might be a better way to go because we can always offset it as we've seen before. But by getting into a forward contract, that we're pretty much showing that we really intend to buy currency. Okay. Now, what exactly is happening here? So they're telling us if you are hedging your payables, then you're going to borrow funds in the local currency. So in order to hedge this exposure with a money market hedge, the firm can borrow dollars today, use them to buy pounds, invest these pounds. And then this is the example I showed you a few minutes ago in a British account or bank account, I guess, or money market fund. And then at the end, in the future, repay the dollar loan. So the amount repaid in the dollar loan represents the cost of buying pounds in the future. So I think I have a numerical example over here that I've worked out. Yes, I do, as a matter of fact. So I think you'll find this very interesting. Why don't we try this case? I want you to see the exact numerical details. So because it's fun to talk about this stuff, but I mean I really want you to see the numbers. So here's the deal. A US importer, it's the same setup. Will hold on, need to buy again 100,000 pounds, let's say. In 3 months. Because they have payables. Okay. So we bought some merchandise on account, let's say, and we're going to have to pay it back in 3 months. Fine. And let's just say this time the spot exchange rate is $1.32 per pound, and the 3 month forward exchange rate is $1.36 per month or per pound. What do I say? Per pound. Fine. All right. So now, by the way, the forward price isn't always higher than the spot price. It just worked out that way. It can go either way. I think we already discussed this earlier in the course. Because of the interest rate parity condition, or the interest rate parity condition shows us that the relationship between the spot and the forward exchange rate is related to the difference between the interest rates in the two countries. Okay, so that number will reflect which country has the higher interest rates at that moment in time. So it could go either way. In fact, they could be the same if the two countries have the same interest rates. All right. Now, here's the part that we haven't discussed before. Let's say that just to keep things simple, it is possible to borrow or lend pounds at 6% and dollars for 8%. Now, of course, normally this is not the case. Usually there's a difference between the borrowing and lending rates, but let's just keep it simple and say that you can borrow or lend at 6% if you're using pounds and 8% for dollars. So how would this work? So remember, the importer needs to buy pounds in 3 months. So we know that the strategy from up here is this. All right, so I'm going to copy this again so we can see, use this as a guide. But now we're trying to figure out the exact amounts. So the US firm will borrow 132,000. Now, oh, by the way, don't forget, this is 3 months. Um, these are annual rates of interest over a period of 3 months. The British rate will be approximately, we can round it to 1.5%, and the US rate 2%. No, there's a quarter of the end, just to keep it simple. Okay, now that's not perfectly accurate, but it's close enough. So we're going to take 132,000. Now, why 132,000? Because right now, if I went to the market and bought 100,000 pounds, I'd have to pay $132,000. That's the spot exchange rate. The problem with that then is that I'm tying up funds for 3 months. And I would love to be able to earn some interest on those pounds, which I probably could, but 132,000 is the starting point. But because I am indeed planning on investing them in a British pound bank account, I have to take into account how much interest I can earn during that time. So that's what this part is all about. So in other words, I don't really need to borrow the full 132,000. I can get away with 130,049.26 over the current spot exchange rate, which means 98,522.167 pounds. So in other words, what I need to do is borrow exactly enough money in the United States to acquire 98,522.167 pounds. Now, why, again, why that much? Because I'll put a note here, if the company or firm invests 98,522.167 pounds at the British rate of 6% for 3 months, they will be worth exactly 100,000 pounds in 3 months, which is exactly what we need. So that's why these seem like very peculiar amounts. Um, so at the same time, though, the US dollar will be repaid in 3 months. And the firm will pay. So remember, he borrowed 130,049.26. The interest rate is oh wait, sorry. Yeah, no, I had it the first time. 130,049.26 times 1 plus US rate, remember, is 8%. So if you take out your calculator, let me just confirm this real fast. 130,49.26 times 1.02. Let's see. 132. Um, I have a slightly different number on here. I want to see where I made a typo here. We know that the pounds that we borrowed will be worth exactly $100,000, 100,000 pounds in 3 months. That's perfect. It's a dollar amount here that I'm double checking. Oh, um, 130. Yeah, so that's going to be 130,049.26. The US rate is 8, so I borrowed dollars. So after 3 months, I'm going to end up paying 2%. And that's 132, 650. Wait, no, I still have it wrong. 130,000. I'm sure I made a typo here somewhere. Hold on one second. 130,000. Oh, I think I found it. Yeah, 132,650, let's say. So, in other words, in 6 months, here's the whole thing. In 6 months, the 3 months rather, the firm is paying 132,650 for its loan, or to repay the loan, but has a British pound bank account with a balance of 100,000 pounds. So in other words, we now use those pounds to pay off our payable. The cost per pound has been locked in and so it's 132,650 divided by 100,000 pounds, $1.32.65 per pound. Okay. So in other words, the point of all this is that we didn't use futures or forwards. All we did was borrow in the United States and lend in the UK. That's the bottom line. And yet we still managed to lock in the price that we paid for each pound. Right. So that's what I wanted you to see. This is the strategy. We are borrowing our own currency to convert them into the foreign currency, but yet we are investing them in that foreign rate of interest, which you may be able to find a euro sterling account, but normally, in order to earn the British pound rate of interest, you've got to have pounds. I mean, end of story. So I can't. One thing I can't do, even with euro dollar accounts, is I can't invest dollars in a bank account and expect to be paid the British pound rate of interest. It doesn't work that way. So I have to hold the currency in which I want to earn the rate of return. So that's what I've done here. I've converted my dollars into pounds so I can invest them in the UK rate of interest. In the meantime, my loan will be repaid at the US rate of interest. Okay. All right. So are we clear on that? But the bottom line is the cost of the loan is actually the cost of acquiring the pounds because they use the loan to buy the pounds. And so this way, no matter what happens, it's $1.32.65 per pounds. Now, if you notice, I'm investing in very safe banks. I'm not putting these in some dicey bank, that is about to go out of business. So in other words, this is considered to be a risk-free transaction. All right. So, we don't have to worry about that. It's a done deal that we've locked in the cost of $1.3265 for each pound that we will acquire in 3 months. And so this again is a money market hedge. Okay. And by the way, there's no real transactions cost. You don't normally pay money. Well, I guess there's some fees involved with borrowing, but you don't have to pay a fee to put your money in a bank account. With forwards and futures, there is no price attached to the contract, but there could be transactions fees. There's like if you go to a broker and say, listen, I need a futures contract, there's going to be some fees involved. Like you have a Charles Schwab account, for example. They're not going to do this for free, but I do not know exactly how much it's going to cost. So it may be that the money market strategy is cheaper than using futures or forwards, but possibly not. We'd have to look into that. But the logic here is that we can do our hedging without needing the derivatives markets. All right, so that's that one. I wanted to make sure we saw that money market approach. Then, what we're going to see here, and by the way, don't forget, all of this involved hedging payables. Right there. Every one of these examples involve hedging payables. What about receivables? Suppose we're earning revenues in a foreign country. Okay. Yeah, before we forget, they want us to now determine what would be your your options position. So hedging payables with an option. So in other words, remember, with payables, a firm that has payables that are due in the future must buy the foreign currency either today or in the future. I mean, that's the bottom line. Having payables implies that at some point we've got to buy the currency. So you probably remember from our discussion about calls and puts that a call is used to hedge the future purchase of an asset. Okay. Or I'll put this in parentheses in case you forgot, or to speculate on the price of an asset rising in the future. If you think that, let's say, gold is going up and you want to make some money, you could buy a call on gold. And if you're right, you will do very well. And then that implies, of course, that a put is used to hedge the future sale of an asset, or possibly to speculate on the price of an asset falling in the future. Okay, so that being the case, a firm that has receivables, which we'll be discussing in a bit anyway, has receivables that will be received in the future or will be collected in the future, must sell the foreign currency as soon as they're in the future. Therefore, hedging receivables be done. Okay, so that's a basic logic. Calls will be used to hedge the future purchase of a foreign currency, meaning that you're hedging payables. if you have receivables, you would use a put because you're going to have to sell that currency in the future. In other words, if I have pounds coming in from a British division, there's going to come a point where I want to sell those pounds because I can't spend them in the United States. Okay. So I think what they did here was it looks like this is not definitely not the pay up to call option. I think what they did was they combined the position in the underlying asset with the call to come up with this plot. I don't really, so I think what they've decided to do is set up this little set of scenarios where, um, let's say you have payables denominated in euros. The exercise price of this call is $1.20. The premium is $3. We got three scenarios where the exchange rate in 3 months is either $1.16, $1.22, $1.24. We paid 3 cents per call. The strike is $1.20. So that means here we let the option expire rather and pay $1.16. In these two cases, the option finishes in the money. So therefore we use it to pay $1.20 for our euros. Then here they've simply added the 3 cent premium. And then they're saying here, listen, in these three scenarios, the cost of buying 100,000 euros will be 119,000, 123, and 123. So in other words, yeah, means including both the asset they were buying and the call. This is our final position, meaning that we're going to pay at most $1.23, including the premium, but it could still be less. And of course, that's the genius of options. But of course, we also have to pay this premium whether we use the option or not. That's kind of the trade-off. All right. So then, then they're trying to mention here that one good thing about a forward hedge or a money market hedge is that you've locked everything in advance, the date in which everything takes place, the cost, et cetera, et cetera. Now the call options rather, the only thing that could be a bit awkward is that the maturity dates are typically only available on a monthly basis. In other words, you might be able to get a call option that expires in, March, April, May, June, July, et cetera. But usually they expire, I believe with options, it's the third Wednesday of every month. The date on which your transaction takes place is different. That's going to lead to a little bit of uncertainty with your hedge. So there could be some room there for your hedge being less efficient than it could be. But if you plan it carefully, this doesn't have to be a problem. So like usually they recommend that you choose a maturity date later than the date on which you have to cover your payable so that you have the option of choosing whether, and also you'd probably want to use an American option in those cases so you can exercise it if you have to. Oh, they have their own example. Now, this is apparently based on the previous case. They had 100,000 euros exposed. They have payables. They have to pay 100,000 euros in 1 year, according to this. The forward exchange rate is $1.20 per euro. So that means, in a year, we're going to need $120,000. The money market hedge, remember, you always borrow the domestic currency and convert to the foreign if you are hedging payables. And they're doing what we suggested. You borrow the dollars, convert to euros, invest in euros, repay the dollar loan in 1 year. So we start with 95,238 euros, which is equivalent to $112,381. And at the end of the year, that's going to be, because the interest rate in the United States is 8%, we're actually going to end up paying $121,371 in exchange for 100,000 euros. Okay, so that means we've locked in the price of $1.21.371 per euro with our money market hedge. So this is just like the ones we did. Okay. Now here, what they're trying to do is say, well, listen, if you're not sure which strategy to use, you might want to engage in a little scenario analysis where you just say, listen, I know these are different possible scenarios for next year, but what if I were to attach probabilities to them? Then you could say, listen, I can calculate the expected cost of these option euros rather. And so what they would have you do. And by the way, this could be converted into the price per euro very easily. So what you could do, let's say, is um, uh, here it is. Let's say I think of this as $1.19 per euro. Oh, here it is. Sorry, you do it directly. So what I'm going to do is multiply each of these by the probability. And what I'm going to end up with is the expected cost per euro. Now, keep in mind the money market hedge locked in a price of 1.21371 per euro. Let's see where this option hedge brings us. All right, you multiply those out. Oh, I just realized this is not 20, it's 0.20, sorry. Oh boy, I did something wrong. Hold on a second. Anyway, it works out to 1.222. So if your probabilities are accurate, that means that on average, this is going to cost you $1.22.2 per euro, whereas the money market hedge was a guaranteed 1.21371. So that's your only consideration. Then that would suggest that you should really think about using the money market hedge. What this doesn't really, well, it kind of does and doesn't. Um, it kind of glosses over the idea that with the options, you're getting more flexibility though. This is a done deal. It's locked in. You can't take advantage of higher prices, or in this case, lower prices. But here you can. And so if these probabilities are off even a little bit, you might end up regretting this. But with the numbers you have, the way it's set up right now, the cost of hedging with the money market is slightly lower than it is for options. Well, that's kind of an important detail. Now, you have all these options, these choices facing you as the multinational corporation. You've got an entire department, the Treasury Department of your company is set up to consider these hedging strategies. And it's important because you could potentially save the company a lot of money if you do this well. So you got to sit down and make some hard decisions. For example, first of all, you got to decide whether you should hedge or not. If your exposure is small enough, it may ultimately not be worth your while to hedge because the cost would be excessive. Like, what if you're a little company and the amounts involved are only a few £100 or a few hundred euros? It may not be worth your while to develop a hedging strategy. But even if you are a big enough company, there's a lot of considerations here. There's always going to be the choice of hedging or not hedging. because we don't know what the future holds. And if we're going to hedge, we have to decide if we want to do futures or forwards, money markets, or currency options. Now, there's probably others too, but these are the standard ones. Now, you in this day and age, you can always go down to Wall Street and have one of these investment banks design some kind of security for you that might be a little more suited to what you need, but that could be very costly. Okay. All right, so let's see, what are they doing here? They're comparing the three outcomes that we are just looking at. Let me make this bigger so we can really see it. So in other words, the forward hedge locks in a price of $1.20. Doesn't say what currency this is. All right, well, whatever. Okay, let's just say that this is $120,000 to be paid for 100,000 euros. That means the cost, the entire transaction is 120,000 with a forward hedge. It's guaranteed to be 120,000. The money market hedge, yeah, this is definitely the euro example, because remember we saw how they determined that the net cost is 121,371. The reason why this one is higher is because we were forced to borrow at the higher interest rate and lend at the lower interest rate. Okay, had it been the reverse, then the money market hedge might have actually been cheaper than the forward hedge. The currency, now here's the thing. We have one outcome where we end up paying 119,000 and two where we paid 123,000. So we discovered that the average in the center is right here. Okay, so that's the relevant number. That's the expected cost. And then, now this is, now there, I don't know, they didn't mention this scenario analysis that I could see, but let's say that this is what we expect to happen in the spot market in 1 year. The cost of buying those euros will either be 116,000 with 20% probability, 122,000 with 70%, and 10% 124. All right, so oh, actually, I know where they're getting this from. That was the chart with the options. On the far left, you'll see that, yeah, like this is what they're referring to. So what they're figuring out here is the expected exchange rate itself. All right, so if you, hold on, that number we need to know as well. It's going to turn out to be, so here's what you would do, is you'd multiply the first exchange rate 116 by 0.20 plus 122 times 0.70 plus 124 times 0.10. So keep in mind, this is the unhedged cost of your position. What you're seeing directly above it, this is the cost of hedging with a call, meaning that if I hedge with a call, I'll lock in a price, I'll have an average price of 122.2. This case, where there's no hedging at all, gives me an average of 116 times 0.2 plus 1.22 times 0.7 plus 1.24 times 0.1, $1.21. Ooh. Well, now you're saying to yourself, well, listen, in that scenario, maybe I shouldn't hedge at all, because the average is only $1.21. Now, that sounds superficially plausible. The only problem is it does not take into account the uncertainty. So I'll tell you what I'd like to do. Let me bring these into Excel real fast. So I'll show you exactly what I'm referring to. So we've got the four basic, well, three hedging and one non-hedging scenario. So we've got the forward hedge, where we have one scenario, which is um 120,000 or $1.20 per euro with a probability, actually, let me leave it like this, 100%. So in other words, we're figuring out the cost per euro and the probability. With the money market hedge, 1.21371 with probability 100%. Then we have the currency hedge, or sorry, currency option hedge. Where there's two possibilities, $1.19 per euro has a probability of 20%. And the other possible outcome is $1.23 with 80%. Now, this one is different because here we locked in a guaranteed price of $1.20. So we're going to call that the expected cost. And to the right of that, we're going to have the risk as measured by the standard deviation. So this is how we're going to compare the scenarios with each other, not just the expected cost of the currency, but the risk. So the expected cost, in this case, it's just $1.20. The risk is zero. There's no risk. Okay, it's a done deal. Here we have the same setup. I forgot to put it up here. Same thing. It's just this number is locked in. The risk is zero. But now we have a different situation altogether. We've already calculated the expected cost as $1.19 times 20% plus $1.23 times 80%. Fine. Okay, it's actually 122.2. The standard deviation will be this. All right. And then the last case where it's completely unhedged. Three possibilities are 116 or $1.16 at 20. Let me just confirm that. 20, $1.2270%, and $1.24. 10%. All right. So the expected cost we've already seen. We can do this very quickly in Excel with some product command. $1.21, which is actually one of the lower ones, although not as low as the forward hedge. This the risk hold on one second. This is going to take a minute because there's three of them. About 2.5%. So now, of course, realistically, you can't directly compare them to each other because we have different expected costs, we have different risks. But the bottom line here is that this one, between these two that are risk-free, we have the lower expected costs with the forward hedge. So if you're thinking about doing one of these hedges, chances are you're probably going to choose this one. Okay. You certainly don't want this one because you're locking in a higher cost and a higher risk. And the same thing actually is true here. The cost of not hedging is that you have a higher cost and you have a lot more risk. So this means that it's possible to compare these side by side, but this, of course, depends on your probability distributions being accurate. If you notice, if you've made bad assumptions, then of course this is not going to help you that much. But if you have done this well, then you can easily analyze the relationship between these four cases and decide which one makes the most sense. Okay. So I like the idea that they're doing all of them: the forward hedge, the money market hedge, the currency hedge, and then our currency option hedge, and finally, what happens if we don't hedge at all? Now that means, of course, that we have to make forecasts and we have to look at the economy and we have to decide what's going on. But if we can do this right, it should help us do the best possible job with our hedging strategies. Okay, so now here what they want you to do is just notice that you can actually evaluate the performance of past hedging decisions. You can do this in a few different ways. But basically what you're interested in is they're defining something called the real cost of hedging, which basically means what would the cash flows been if you hedged versus did not hedge. All right. So in other words, if the cash outflows were greater than without hedging, then you certainly were wasting your time hedging your risk because you should have just left it alone. Otherwise, if the cash outflows are smaller, then you obviously are better off hedging. And you can run a regression and you can do all kinds of things to figure out what has happened in the past. Now, all that discussion up to this point involved payables. The shoe is on the other foot with receivables because we now have currencies coming into our pockets, and we hope that their value grows, but if it doesn't, we can end up losing money. Okay, so all of our positions will, or strategies will be reversed. So how, for example, would you hedge exposure receivables with an option? Well, clearly, if we're hedging, let's go back to our document. So, like I said, everything up to this point involved, here it is, hedging payables. Let's create a header there so we don't lose it. Okay. What about receivables? Well, basically, you're going to go through this in reversal of these. For example, they want to start with a discussion about options. And so naturally enough, since payables can be hedged with call options, receivables can be hedged with put options. This is because the multinational corporation will have currency will have foreign currency in the future that will need to be sold for dollars. Okay, so it should be sensible to think that if we have something to sell in the future, we're going to hedge it with a put option. All right, so that's correct. Now here, this graph represents what happens when you combine an existing position with a put. So yeah, here's the table. Let's say we're dealing with, oh, it's the Swiss franc this time. How about that? Okay. The strike is 72 cents. The premium is 2 cents. Here's the three scenarios. Here's the spot exchange rate when we receive the Swiss francs. Here's the premium. And uh, oh, okay. So what they're saying here is that if the Swiss franc drops to 71 cents per 0.71 per Swiss franc, you'll exercise the put and sell for 72. So it means that in this first scenario, the put finishes in the money. In these two cases, it's not. The price is higher than 72 cents, so we'll allow the put to expire and instead we'll sell at the market price. Okay. And then that means when you take into account the 2 cents we paid for our puts, this is how much goes into our pockets. And then because we're assuming that we hedged receivables 200,000 Swiss francs, that indicates that in the first case, the product of 200,000 by 70 cents is 140,000. And similarly for these two. So if we had some probabilities here, we could actually construct another scenario where we calculate the expected cost of hedging as well as the standard deviation. I guess they decided not to do that this time. Now, here is a money market hedge. Now remember, so let's go back and revisit what happened up here. Everything's going to work backwards. So let me copy this real fast. So we're going to borrow the foreign currency, which they're talking about Swiss francs here. We're going to use those to buy dollars, invest these in a US dollar bank account. Sorry, invest these dollars in a US bank account. And in the future, of course, we pay the Swiss franc loan. So the amount repaid to the Swiss franc loan represents the revenues from selling I'm sorry, the amount collected from the dollar loan the dollar deposit, let's say, represents the revenues from selling Swiss francs in the future. So in other words, it's locked in advance. So in other words, if you notice here, we're expecting to receive 200,000 Swiss francs in 6 months. And the forward exchange rate at the moment is 71 cents. So if we enter into a forward contract, oh, they forgot to mention that one. The future sale of Swiss francs can be hedged. Let's enter this right now by entering into a short forward position. To sell Swiss francs in the future at a predetermined price. So in other words, they're just saying it's easy to forward hedge. You just sell it forward at this forward exchange rate, and that locks in $142,000. Now here, if you notice, they're following our strategy: borrow Swiss francs today, convert to dollars, invest in US dollar bank account, and then use receivables. Oh, I forgot about that little detail. You're paying the loan back with receivables, right? Remember, we are collecting this money, Swiss francs. We're owed Swiss francs. So when we pay this loan back, it's not coming out of our pocket. We're using our receivables. So that means that the dollar bank account means how much money do we earn by selling these Swiss francs. Therefore, if let's say, oh my God, they didn't mention specifically, but the 3% would be the Swiss franc rate of interest. We borrow 194,175 Swiss francs. Yeah, this is very awkward when they don't tell us the assumptions. Yeah, I can't stand it when they do this. So it looks like the Swiss franc rate is 3%, and the spot exchange rate must be 70 cents per Swiss franc, so that this is equal to 135,922 US dollars. By depositing them in a US bank, where the US rate is 2%, in 6 months, these dollars will be worth 138,640. Oh, that's it. All right. So in other words, what they're showing us here is that the forward hedge was actually more expensive. Oh, actually, no, I'm sorry. In this case, we're trying to get the highest price. Before we were trying to pay the lowest price. Now we're trying to receive the highest price. So here, the forward contract is clearly the better of the two choices, because the money market hedge only brought us 138,640, whereas this brought us 142,000. So in this case, we were better off with the forward hedge. But that again, it depends on the relationship between the spot and the interest rates in the two countries. And then they're going to give us a scenario. Once again, just like before, we can go through, we don't have to do this again, but you get the idea. You can set up a table with all these scenarios and you can determine not only the expected revenues from these different hedging strategies, but also the standard deviations. Wow. And that way you can make decisions about which one you should use. All right. So it would be just like this, except that you remember here we were buying and now in the second scenario we're selling. Okay. So now they've got this nice little chart that tells us, reminds us what you do with each of these instruments to hedge payables, and then what do you do to hedge receivables? And this is exactly what we went over. Futures hedge, forward hedge, to hedge payables. You're going to enter into long forward or futures position to buy. Over here, you're entering into short to sell. With the money market hedge, over here, you're borrowing the local and lending the foreign. Here it's the other way around. And with options, here you're buying a call, and here you're buying a put. And it's that simple. All right. Now there are, of course, there's some institutional details that might actually help us make a decision here. For example, they mentioned that money market hedges can by definition only last fairly short periods of time. So that means if you're using money markets for a relatively long exposure, you might find yourself paying a lot of transactions costs to continuously roll over those foreign exchange exposures, where a forward contract, you can literally negotiate anything. If you've got a 10-year exposure, no problem. You can negotiate a 10-year contract, and then the transactions costs would be quite low. Quite low. All right. So, sometimes there are reasons why you might choose one strategy over another, not just because of the standard deviation, for example, but because of institutional details that limit what you're doing or else affect the cost. Now here they're trying to show you the high correlation between the forward and the spot rate. This is a discussion where you're rolling over a forward contract, but this assumes that the currency is continuously appreciating. Okay. Oh, here's an interesting idea, cross-hedging. Let's say that you've decided to use a futures contract to hedge your exposure to, I don't know, how about the Swedish krona? And the problem there is that the futures contract, there isn't one available on the Swedish krona. So a cross hedge means that you might instead use a futures contract on euros, because the fact that the krona and the euro are highly correlated with each other. So in some cases, when the instrument you need is not available, you can engage in cross hedging, by which you're using related security in order to hedge your exposure. It sometimes happens with futures contracts. You don't have to worry about that with forward contracts because they're completely customizable. All right, so I think that we did a very nice job with a very complex topic here. Rather than having a break, I think what we should probably do here is just stop right here, because that's all the content we have. What I'm going to do is save this spreadsheet so you can look at it later on if you want, as well as this document where I wrote some extra notes. But I think we've kind of covered the material. So rather than, just hanging around just for the sake of hanging around, why don't we stop right here and not have a break? And then that way, next week we can pick it up with chapter 12, which is another kind of hedging, if I remember correctly. But I think for now, I think we have quite sufficiently covered this topic, and we can stop right here. And remember, last week is our last online meeting. The following week, we have our final in-person meeting, so I'll remind you about that. So for tonight, we'll stop right here, and then you should be ready to do whatever they ask you to do in MindTap. And then next week, we'll have that one final online meeting, followed by the last in-person meeting. All right, how does that sound?
Sounds
Pretty
good.
good, right? Excellent. All right, so I'll see you all next week then.
Thank you. Goodbye.
All right,
Thank you.
good night, everyone.